welcome those who have joined us today, specifically for this session. Please, with a round of applause, help me welcome those who are joining us for the first time at the summit. You're most welcome. Yeah, earlier today, as DG Hannah was sharing the good news about the Public Offer Directive, she mentioned corporate governance as one of the provisions in the directive. And throughout the day's sessions, we kept hearing corporate governance in relation to issuers of securities. So this afternoon, we're going to delve deeper into what corporate governance means, and just a few thoughts and perspectives about it in relation to issuers of securities here in Ethiopia, and also learn from the experience of others in other countries. And later on, after our session, we're going to transition into the launch of the ESG guidelines for the banking sector. And we're very excited that we'll also witness that this afternoon. And we'll be hearing more of what is ESG. So as you have heard, we have a very distinguished panel today. And we are going to briefly introduce this discussion. We plan to have a more detailed conversation and discussion on corporate governance later on, and you will hear a bit more of that as we go along. So to start us off, Rose, you're the corporate governance specialist at IFC, and you've also worked as a regulator in the past, reviewing compliance and alignment with really the corporate governance standards. Please start us off by telling us what is corporate governance for someone who's hearing and wondering what is this, and what is the importance of corporate governance and its key components in relation to capital markets and issuers.
Thank you very much, Grace, for that kind introduction. Every person that has come to me today and had conversation with me have actually told me, oh, Rose, we should have had a longer session on corporate governance. And I said we have a very long time since from the beginning of the capital markets to talk about corporate governance. And indeed, for the last 8 years that the IFC has had a program here in Ethiopia, we have spoken to various pockets of interest stakeholders on corporate governance. So to go to the question that you have asked me, Grace, what is corporate governance? I know many people speak about the processes and the structures that are used to govern companies, but allow me today to give it a new definition and really say that corporate governance is an ecosystem. It involves many parties, it involves many stakeholders, and it involves several people. And really, for it to work in a market, it has to be practiced. So what is it? It is that ecosystem beginning from policies that regulators and governments must establish to govern their market, coming down to the laws which then must naturally follow the policies, and then we come now to the practices by companies and stakeholders. And so for our capital markets, obviously we have set up the policy in the direction in which we should be facing as the Ethiopian capital markets for corporate governance. We have several laws, and now we are on the third phase of practicing that good corporate governance. So it is the policies, the laws, the practices, and the parties that must be involved on a daily basis to make corporate governance successful. And so you ask me, why is it important to have a corporate governance? There are several benefits of good corporate governance practices. Number one, good corporate governance practices will give our investors confidence. Why and where will that confidence come from? It will come from the fact that we will be governing and leading our companies so well, they will be performing so well, the risks that should be falling on those companies will not fall on them. And therefore, people will be very confident in investing in our market. Number two, obviously, then that will make our market integrity be very high. And when I talk about market integrity, I mean that the practices, the ethical practices, the release of information, for example, will go out equitably to all the investors, which is a paramount need for any capital markets. And of course, any company that practices good corporate governance has very easy access to capital. The IFC that we have spoken about the whole day, and really where I work, normally invests in companies that are well governed. When we do the investment, the first thing we do is look at the corporate governance practices. We ask ourselves, who is in the board? What qualifications do they have? Is there a balance in that board? How do they make their decisions? What risk will we have if we put in our money? Will we have a return as IFC? So any company and all the companies that will be listed, and of course who will be needing capital on an ongoing basis, will easily access capital in a cheap way if they have good corporate governance practices. The other benefit of good corporate governance practice is sustainability. Obviously, if you have your good board in place, you have your practices in place, you're making your good decisions, you know what your risk is, your business will be run in a sustainable manner. It will be profitable, it will be sustainable in the long term. Another component of good corporate governance practice is risk management. An important part of corporate governance practice is for companies to know their risk, to set their risk appetite, to know their risk, to have their risk mapped out, to ensure that they have in place strategies to ensure that the risk does not fall on the company. And if it falls, then to put in the strategies in place to ensure that the investors in their shares do not lose out. An important aspect of good corporate governance practice also is accountability and disclosure. Capital market is about information. One of the laws, or one of the provisions in the laws that the ECMA has issued out is on release of information. Investors invest in capital markets using information. They also divest. They sell their shares using information. And so therefore, that tenet of good corporate governance practice ensures that information goes out timeously to everybody equitably. So if the performance of the company is being announced, that information goes out at the same time to all the investors, and they can make decisions that way. The other benefit, obviously, of good corporate governance practice is brand and reputation value, and I really don't want to overstate that one. If you have good corporate governance practices, you attract the best employees, you can retain them more, your brand, your products are, they speak for yourself because you have in place those good leadership values. And then for the capital markets, good corporate governance practices enhance market efficiency. And efficiency is in the trading of the shares, it is in the information that goes out to stakeholders, it is in the management of the companies that are listed, and also efficiency in the submission of information to the regulator. So you can see that it is very important to have a good corporate governance practices. The last one I'd like to talk about, Grace, is on the protection of the minority shareholders. And actually all shareholders. So good corporate governance practice demands that companies and boards must take care of all their shareholders. Shareholders must be treated equitably. Information should go out to them in an equitable manner. If there is going to be an annual general meeting, everybody should be invited, and their share rights and obligations are clearly spelled out for them so that they have that protection. I think I'll stop there, Grace. Of course, there's much more I can say, but let me stop there for now.
Thank you, Rose. That was a very good overview and introduction, and has shown us just how important corporate governance is. Mr. Mwangi, you run a law firm now, but before that you were also overseeing governance in listed companies, and you can briefly tell us about that, but more importantly, what are the main challenges of implementing corporate governance and the common pitfalls that you would advise Ethiopian companies to avoid or to take into consideration based on the experiences that we've seen in other markets? Thank you.
Okay, thanks Grace, and good afternoon to you all. So like Grace has said, my name is Mwangi Mbogo, and I've had a career that has had many iterations. In one of them I was a regulator, and then I made the leap that most people who work for regulators make, which is to join the private sector. And recently I find myself practicing in a law firm in Nairobi.
You know, in family-owned business, there are related party transactions, nothing wrong with that. Once you become a public company, that's a bit more difficult, so it kind of makes sense that you would have a robust process to approve those and a lot of disclosure so that people who are not part of those transactions don't feel like they've been had. Another area would be, for example, protection of minority rights, and you've talked about that, Rose. But exactly when AFC makes investments in emerging markets, it's often as a minority investors, and so it's very important for them to secure the rights to their investment, having the opportunity to exit when there's an exit, participate in corporate transactions. So I guess my answer back to Mwangi, or the counterweight, is that these are self-evident structures and mechanisms you want to put in place so that actually your interests are protected. And then I think it's a good segue to then hear from Sirak of the type of efforts that have been put in place at ECMA to bring all these different regulations and codes together in some guidelines and practical tools that companies can use.
Thank you, Jerome. I think you've given us some insights into how we can kind of address the concerns of some of the owners of the companies and how to kind of bridge strike a balance, between the practices and the concerns and the tension that we see. Sirak, as a regulator, there must be initiatives that are taking place. I think as DG had mentioned some. So perhaps you can just share with us, first, what's the current state of corporate governance practices in Ethiopia and the status of the frameworks and regulations that you're working on as ECMA.
Thank you, Grace. Good afternoon, everybody. My name is Sirak Solomon. I'm a senior legal advisor with ECMA. So maybe I start with what's currently on the ground, and then we can talk about some of the things that we're doing as an authority. So I was trying to take notes of the various things Rose listed for what is a good corporate governance practice: risk management, sustainability, disclosure, shareholder rights, related party transactions. Out of the many, these are kind of the ones that I listed. So there's several, maybe there are 4 laws currently in practice, currently law of the land, that are applicable, that govern some of these practices. One would be the Commercial Code, which was amended in 2021 after many decades. It kind of outlines the Commercial Code of Ethiopia governs PLCs, which are small companies, and then share companies, which are like corporations. So it governs registration requirement, corporate structure, responsibility of directors, rights of shareholders, and outlines kind of general, very minimal, but some requirement of board composition, and it talks about roles and responsibility of management of board. It also has provisions related to shareholder rights. Very minimal, but it does have provisions. Second is kind of the regulatory framework of the National Bank, which governs banks, insurance, microfinance institutions. So the national bank's directives actually go above and beyond what the commercial code has, and top up that with more board composition requirements, independence requirements, risk management, internal control requirements, provisions related to transparency, board responsibilities, and disclosure of conflict of interest, things like that. The third is the financial reporting requirements. So Ethiopia, as you know, has adopted IFRS framework. Under the IFRS framework, there are certain provisions related to disclosures related to corporate governance. Those are not in effect yet, S1, S2 requirements. So that would be, currently adopted practice. And the fourth and final one would be what comes under the Capital Market Proclamation. So those are provisions related to disclosure requirements of public companies. And the announcement earlier this morning about the Public Offer Directive has requirements on what the authority as a regulator would expect of public companies. Public companies coming to the market to raise equities, debts, and the disclosure requirements related to the 5 things that Rose outlined, how we treat those, and the idea being that good corporate governance means better companies, better in terms of profitability, the sustainability, and obviously if you're a better company, you're more investable, you have access to cheaper money. I mean, basically that's what it means. You come to the market at higher valuation if you're doing equity, or lower interest rate if you're doing bonds. Better managed companies have access to cheaper money. I mean, that's basically what corporate governance brings to our companies. And so in terms of, that's what we have in the ground. In terms of what we're doing as an institution, the proclamation outlines that the authority would set guidelines on corporate governance. So this is kind of standardization of a minimum requirement across the board for public companies. Obviously, we regulate the public market. So debt or equity or all the other securities, any offerer, we set minimum guidelines. And those guidelines are tools that companies come to the market can use to kind of set themselves up. If 10 companies are coming to the market, you want to make sure that you're in the top half to be able to raise the money that you want and to be able to raise it at a valuation that is reflective of the status of your company. And one of the ways that you can do that is by developing good corporate practices. So that guideline is something we're working on. Second is we expect the listing rules of the exchange to have a higher standard, even still above the guidelines, for especially in the main market listed companies. This would be the cream of the crop of Ethiopian companies. And of course, how you define a better bank than another bank when you have 30 banks. One of the ways you do that is by looking at their governance, their risk management, their sustainability. As an investor, that's what you look at to differentiate between different companies. And the other one is, with the privatization that's currently happening, when you privatize state-owned enterprises, especially with the opening up of a lot of the market to international players, what that brings is, the requirement of, if you want to get, like I said, good valuation, good value for money, then you have to adapt these higher standards of corporate governance standards. That's how you align the interest of the investor with the interest of the company itself. So that's another area that we're working on. Obviously, the team that you see on this panel is the same team that's developing the guideline. So we're working hard to put that to the market. It will be coming to you to make sure that is aligned with your expectations, best practice, and make sure, obviously, we don't want to make it too high of a standard that is not easy to implement in the short to medium term, but but we wanted to have a standard that is manageable and a floor for all our companies with some aspirational kind of provisions as well. Thanks.
Thank you, Sirak. And thank you for mentioning that in terms of just the work. And it sounds extensive. It's covered at different levels. And as we said earlier, and as Sirak, you've affirmed that we are going to come with a more detailed, with an opportunity for more detailed and more in-depth discussions on this. Rose, you had a comment?
Yes, Chris. So I just wanted to add to what Sirak has said on the legal framework for the country. The IFC is also supporting the Accounting and Auditing Board of Ethiopia to develop a more wide framework for all the companies in Ethiopia to begin understanding and practicing good corporate governance. But also to add that for a market to appreciate the need for good corporate governance practices, we really must establish the business case for it, to show companies and for companies to appreciate why. What is the business case in it? What is in it for them? So what if they don't adopt good corporate governance practices? Once we have convinced companies that, you know, it is good for you to practice good corporate governance, and also it is good for you to adopt the standards to report frequently, then I think we can begin our journey to good corporate governance practices. In corporate governance, we say corporate governance is never a destination, it's a journey, and we must travel that journey. The crime you commit is not to begin traveling on that journey, because, you know, we have various standards and levels of corporate governance practices. Obviously, for a new business that was begun yesterday, we will not expect them to even know. But if you are 2 years old, I mean, you should really begin practicing, like having your records, then move to stage 2, stage 3, and stage 4, where it is now total adoption of good practices. So it's a journey. And the encouragement to the issuers, prospective issuers, is to begin walking that journey. But that journey begins by being aware and appreciating the business case for good corporate governance practice.
Thank you, Rose. Before we wrap up, Mwangi, you have a comment as well?
Yeah, so just a comment,
Briefly.
and maybe it's building up on what Rose and Sirak are saying. One of the ways that we've seen overcoming the challenges around implementation of codes is the convergence of the codes and the law. So infusing the corporate governance principles in company law, or in securities law for that matter. So if during your process of reviewing your laws, you're then able to look at the section on directors, say in the Companies Act or Commercial Code, and infuse these principles in there. You look at some of the provisions on corporate governance, and then say, within your continuous listing obligations, what are these corporate governance principles that you can build in so that issuers are bound in a sense, because the listing obligations tend to be mandatory. And then also looking at working, across the industry. So collaborating with your professionals, so your accountancy professionals, the law society, or however it's styled here, working with those bodies of professionals, because these are your frontline, these are the people who are interacting with the companies every day. So if the process of regulating corporate governance is devolved in that sense, then you begin to see the principles taking root within the community of issuers. Yeah.
Thank you, Mwangi. And I think this conversation can go on. And Jerome, I think as we segue into what we're going to witness today, corporate governance is the G in the ESG. So perhaps you can just help us segue into that by just briefly what is ESG and what are the benefits of adopting ESG practices for issuers of securities. So I think we've talked about benefits generally, but what is ESG and how does it differ? So briefly, and then we will transition. Thank you.
Yes, I hope I'm not going to confuse everyone, but to me, ESG is an evolution of governance. So governance, as we said, is a set of structure and processes to protect the interest of shareholders and different parts of the company. And essentially, over the years, in the last 20 years, the scope of corporate governance has evolved so that corporate governance structures are not just used to protect the interest of shareholders, but also stakeholders. And I don't know if you've heard the phrase stakeholder capitalism, but the idea, or there is a legal debate whether the board owes a fiduciary duty to its shareholders or to the company. This is all related to the idea that the belief that the board and the company owes fiduciary duty to more than just its shareholders. And if you believe that, then the corporate governance should look at other stakeholders, which you could summarize by the environment and society. And you can declinate that to other issues around ESGs, but that's pretty much what it is. One factor that confuses me personally is the G in ESG is typically, if you look at all the standards, the governance of sustainability. In other words, how are the boards and the committees and the risk management applied to look at sustainability impacts? I think what IFC does uniquely, which is great, is always promote the full scope of corporate governance and not just the governance of sustainability, because that's where it starts. I think if you have a company that's well managed and understands its fiduciaries, then the rest will follow and be correctly managed. So not to confuse anyone further, but I think that's my view of ESG, a progression from corporate governance.
Thank you very much, Jerome. And thank you so much, our distinguished panelists. I think as Sirak mentioned, I think you will see us, you'll see more of us, I think, in the coming days as we engage deeper into the corporate governance guidelines and really getting your views and helping to define what will be appropriate for Ethiopia. So please help me thank Jerome, Mwangi, Rose, and Sirak. As they leave the stage, I'd like to welcome my colleague, Betty. My apologies, Rose is here. So I'd like to invite Rose to take us into the next session.